Want to invest in a business that's so rock solid, it's literally the logo of the company? Looking for a safe, growing dividend that's currently kicking out a yield of over 5%? Like the idea of buying a beaten up dividend growth stock that looks materially undervalued? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before we get into today's content, please give us a big thumbs up if you find value in our videos. Helps us get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a world-leading insurer and asset manager. It's rare to see a company taking advantage of one fantastic business model. It's even rarer to find a company taking advantage of two fantastic business models. Well, that is what you have here. A highly successful insurance operation that benefits from the powerful float, and an asset management business that benefits from fees that scale. This 1-2 punch is allowing the company to increase its revenue, profit, and dividend like clockwork. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Prudential Financial Inc., which appear to be trading at a significant discount today. Prudential Financial Inc., stock ticker PRU, is a global diversified insurance company that offers life insurance, annuities, investment management, retirement plan services, and other financial products and services. Founded in 1875, Prudential Financial is now a $34 billion by market cap major financial player that employs more than 40,000 people worldwide. The company serves approximately 50 million customers across 40 different countries. Prudential Financial reports operations across the following 4 segments. U.S. businesses, 44% of fiscal year 2021 pre-tax segment operating profit, international businesses 38%, and investment management 18%. Prudential Financial is one of the largest insurance companies in the world, and what a great business model insurance is. On its face, it seems like a pretty pedestrian way to make money. You charge premiums to insure and you pay out when claims are made. If you can underwrite prudently, there's a good opportunity to make some decent coin in that process. However, this misses the point. The point is that there's often a significant lag in time between premiums collected and claims paid. This time slippage allows for low-cost capital accrual, which is called the float. The float can be massive and it can generate a ton of profit, in many cases even more profit than core underwriting. It's ingenious, and it's why Warren Buffett started to build his fortune by way of insurance decades ago. But Prudential Financial kicks things up a notch by combining insurance with asset management. Via its PGIM business with $1.4 trillion in assets under management, Prudential Financial is also one of the world's largest asset managers. This is yet another great business model, as asset managers are able to charge fees on global assets that should continue to benefit from the rising tide, global productive output, lifting all boats, global assets. Prudential Financial has been doing well for many decades already, and it should continue to grow its revenue, profit, and dividend for many decades yet to come. Already, the company has increased its dividend for 14 consecutive years. The 10-year dividend growth rate is 12.5%, which is great, but more recent dividend increases have been in the mid-single digits. The last dividend increase announced in February was 4.3%. The dividend growth rate has come down, but the yield has come up. Indeed, the stock currently yields 5.3%. That is a rather high yield in both absolute and relative terms, and I think it appropriately compensates for the lower growth. For the sake of comparison, it's 80 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 40.4% based on trailing 12 months adjusted earnings per share, the outsized dividend looks secure. So we've had a shift from a lower yield and higher dividend growth rate in the past to a higher yield and lower dividend growth rate today. This shift has made Prudential Financial particularly suitable for income-oriented dividend growth investors. Yields in general have moved up, but I see the overall package here is pretty compelling. Looking at business growth, Prudential Financial's revenue has decreased from $84.8 billion in fiscal year 2012 to $70.9 billion in fiscal year 2021. While I never like to see a drop in revenue, this is easily explainable. Per the company's fiscal year 2013 annual report, and I quote, "In 2012, we completed 2 significant non-participating group annuity pension risk transfer transactions, for which the premiums associated with these transactions represented approximately 38% of Prudential Financial's 2012 total consolidated revenue," unquote. Annual revenue on either side of fiscal year 2012 had a 4 handle on it, so we can see that the company has meaningfully grown its revenue over the last decade. Meanwhile, earnings per share increased from $1.05 to $19.51 over this period, which is a compound annual growth rate of 38.4%. The company's growth over the last 10 years looks extremely strong at first glance. However, the numbers are also quite messy. Frequent sizable adjustments have to be taken into account. I always like to use a decade's worth of data as a proxy for the long term. In this case, though, I think it's insightful to zoom in on the last 5 years. Earnings per share came in at $17.86 for fiscal year 2017, so we're looking at a 5-year compound annual growth rate of 2.2% for earnings per share. In my view, the truth lies closer to that latter number than the former, and that means the recent deceleration of the dividend growth rate makes a lot of sense. It's also why I would continue to expect the dividend to grow at a mid-single digit rate per year. Looking forward, CFRA has no 3-year forecast for Prudential Financial's earnings per share growth. This is disappointing, as I do like to compare a historical result with a near-term professional forecast. That said, CFRA does provide this nugget, and I quote, "We forecast segment operating revenues will rise by 4% to 6% in 2022 and by 3% to 5% in 2023, unquote. If we assume that bottom line growth would track this top line growth, which is certainly not crazy, we're basically looking at a firm growing at a mid-single digit rate across the board. And that harkens back to what I was just saying about the dividend growth rate expectations. For additional color around the subject, I last studied CFRA's report on Prudential Financial in September 2020. At that time, CFRA was projecting a 4% compound annual growth rate for Prudential Financial's earnings per share over the coming 3 years. I believe that's fair. So we've got an insurance and asset management business that could grow its revenue, EPS, and dividend at somewhere around 5% annually over the next few years. Prudential Financial's float should benefit from rising rates, but difficult market conditions work against their AUM fees. In the end, I think a setup for approximate 5% growth is more than acceptable when you pair it with a 5% plus starting yield. Moving over to the balance sheet, the company has a rock-solid financial position. The long-term debt-to-equity ratio is 0.3. The company's long-term senior debt has the following investment-grade ratings: A, Standard & Poor's; A3, Moody's; A- Fitch. Profitability is solid for the industry, although the irregularity of GAAP results clouds the picture somewhat. Over the last 5 years, the firm's average annual net margin was 6.9% and annual return on equity of 8.1%. Prudential Financial isn't exciting. Instead, this is the kind of boring business that can slowly but steadily deliver wealth and growing income for its shareholders over the long run, which I think is actually quite exciting. And with economies of scale, sticky assets, and established policies, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The company's exposure to global capital markets can negatively impact assets under management and collectible fees during extremely volatile periods. Further pressuring fees, the industry is facing a secular move toward passive instruments with lower fees. Underwriting must remain prudent, but the long-term nature of life insurance makes this difficult to assess in real time. Rising rates are favorable, but any turn toward lower rates in the future could harm the power of the company's float. Broad geographic diversification is a strength, but it also adds geopolitical and currency risks. The risks are worth weighing, but I think the quality and valuation of the business is also worth weighing. With the stock down nearly 30% from its 52-week high, the valuation looks very appealing. The stock's price earnings ratio is 7.6 based on trailing 12 months adjusted earnings per share. Even for a company only growing at a mid-single digit rate, that's low. It's not even close to the broader market's earnings multiple. It's also well off of the stock's own 5-year average PE ratio of 8.5. We can see that the price to sales ratio of 0.5 is lower than its own 5-year average of 0.6. Adjusted book value of $104.19 per share is measurably higher than the current share price. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 5%. It's simple for me. Everything we've gone over points to a company that has grown, can grow, and should grow at a mid-single digit rate. That applies to revenue, EPS, and the dividend. There will likely be better years and there will likely be worse years. That's how it goes in business, but averaging things out, this is what I see for Prudential Financial. The dividend discount model analysis gives me a fair value of $100.80. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Prudential Financial as a 4-star stock with a fair value estimate of $105. CFRA rates Prudential Financial as a 3-star hold with a 12-month target price of $102. We have a super tight consensus here. Averaging the three numbers out gives us a final valuation of $102.60, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. Prudential Financial Inc. has put two terrific business models under one roof, and the company's Rock of Gibraltar logo befits this rock-solid firm. With a market-smashing 5.3% yield, mid-single-digit dividend growth, a low payout ratio, nearly 15 consecutive years of dividend increases, and the potential that shares are 14% undervalued, income-oriented dividend growth investors ought to take a very close look at this name right now. And now for a special news announcement. PepsiCo Inc., stock ticker PEP, just announced a blowout Q3 report, beating on the top line and the bottom line. The company also boosted guidance in a big way. For fiscal year 2022, the company now expects a 12% increase in organic revenue versus the prior growth outlook of 10%. What's happening here? PepsiCo is fighting off and even rising with inflation. We covered PepsiCo in a video back in July, highlighting it as a premier dividend growth stock to hedge against an inflationary environment. Don't forget about PepsiCo. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.